Hi everyone. In this video, we are going to see an example of EVA, Economic Value Added Calculation. This was tested in ACCA exam 2029, September-December exam it was tested. So let's quickly see how to calculate this. This was part of 150 mark question, the first question of Advanced Performance Management APM. I have just extracted the data which is relevant for calculating APM only. So let's see how to calculate APM. So you know the format of economic value added. We take NOPAT, net operating profit after tax, NOPAT, net operating profit after tax, and then you subtract imputed interest. Imputed interest is year beginning capital employed multiplied by weighted average cost of capital, and the answer is EVA. So let's start how to calculate NOPAT. Here they have given operating profit. So let's start with operating profit calculation. Or first step, operating profit. Some questions might give you net profit. So we may have to do a reverse calculation there. But here it's operating profit. Let's start with that, operating profit. 3175. In the meantime, let me write the year beginning capital employed also what they have given. Capital employed during the period opening 19404 is given, the opening capital employed, isn't it? So year beginning capital, if you have calculated residual income in the divisional performance, there sometimes we take year ending capital employed, but EVA you have to be very specific. It is year beginning capital employed. How much is that? 19404. It's given. Now one by one we'll do the adjustments. First one, this includes a depreciation charge of 1780. Accounting depreciation must be removed. Remove means add back and subtract economic depreciation. Add accounting depreciation. I'm writing in the shortened forms. 1780. Subtract economic depreciation. Economic depreciation is given in point number 5, 1907. Sometimes you may have a question, if economic depreciation is not given, what do we do? Then we don't do anything at all. We can just leave these two steps and say we assumed accounting depreciation and economic depreciation are equal, because one is added, one is subtracted. So if that is equal, that nullifies the impact. Okay. Then amortization is a non-cash expense. It would have been deducted in arriving at this figure. Let's add it back. Add amortization. How much is that? 95. Tax we will do at the end. Let it be there. The company has spent 90 million this year and each year for the previous 10 years on long-term brand building. Hold on, if you are doing any marketing activities, brand building activities which will have long-term benefit, what EVA says, that should not be expensed, that should be capitalized and then amortized. So first step, whatever you have expensed this year should be added back. This 90 million has been expensed. Let's add it back. Add brand building. 90. And then the previous years, not current year, because we are taking year beginning capital employed. So before this year, how many years they have done? Previous 10 years they have done this marketing or brand building. 90 million every year. 10 years, it would have been 900 million that they have already spent on brand building, which were earlier expensed each year. But now we say, no, it should be capitalized, which means it should be added to the year beginning capital. Remember, including this year, 11 years they have done brand building. Since I am taking year beginning capital employed, don't take current year's one. Previous 10 years brand building, they have spent 90 million per year. 10-year, multiply 900 million. I'm adding back. Add brand building 900. In summary, what am I doing? Previous 10 years brand building, what they expensed, I am capitalizing. Okay. So if I capitalize this, remember it has to be amortized. Brand building, you don't use it forever. There will be a useful lifetime. There was one point that says, okay, look at point number 6. This year and each year for the previous 10 years, economic depreciation has included 10 million write down of the value of brand building. See, every year they are writing off 10 million as amortization of this brand building. Right? So that I have to subtract now from this 90 million which I capitalized, less amortization of brand building. Up to the beginning of this year, remember. So they have done it for 11 years, including current year. Don't take current year, take previous years, 10 years, 10 million each. Let's subtract it. 10 million, 10 years. Okay. This is done. Economic depreciation is done. This is done. Research and development expenditure 705 was incurred in the period, leading to an economic asset. So you incur some R&D which gives you an asset. Economic asset would not have been reflected in your balance sheet. So I need to do two adjustments. One, this 705 they would have expensed, because research and development expenses we usually expense it unless it gives you an asset which confirms or which conforms the requirements of the standards. So when they say economic asset, probably it would not have been deducted, or it would not have been capitalized. So this 705 they have expense. Let's add it back. Add R&D expense. How much? 705. So you may ask me, do we add back all the research and development expenses? No. If R&D expense gives you an economic asset, some kind of an asset which has long-term benefit to you, which is not reflected in your balance sheet, then we add it back and we capitalize that asset. How much should I capitalize? 4,233? No. That is at the year end. I need to find out how much at the year beginning, because we want year beginning capital employed. We don't want year end capital employed. So look at this. Let's say add back, add R&D asset, R&D economic asset. Look, after spending this 705, now they have an asset of 4233. Before spending this 705, how much would have been the asset? 4233 minus 705. 4233 minus 705. That means at the year beginning, before this year started, whatever they have spent on the previous years would have been the economic asset. Add it back. Why I'm adding it? Because in the balance sheet capital, these items are not included. As per the standards, this research and development expense would have been expensed, which I am capitalizing now. So it's not on the balance sheet. So I'm adding it. Because of that, I'm adding it. Done. Then what else do we have? This is done. Interest paid 213. Anyway, we started with operating profit. Why they have given this interest paid? Look at this tax. Corporation tax. So this tax is based on PBT, profit before tax. So this tax includes the tax saving on interest also. If you remember your tax working, look at this PBIT. Then you subtract interest. And you subtract interest. Okay, interest. You subtract it. So you get PBT. Then you find tax on it. For example, if your PBIT is 1,000, for example, if interest is 200, your PBT is 800. The tax percentage is 25%. This multiplied by 25%. But in finding net operating profit after tax, what we must subtract here is tax on operating profit, PBIT. So tax on PBIT in this case, in this example, what I'm doing here is just an example, not related to this question. Tax on PBIT is this into 25%. Now look at this. The tax paid is 200, but the tax on PBIT is 250. So if this 200 is given, how do I arrive at this 250? Take that 200, add back the tax saving on interest. Interest is 200, tax rate is 25%. 200 into 25% is the tax saving on interest. Add it back with the tax paid. That will give you tax on PBIT. Do the same thing here. Tax paid 694 plus interest 213 multiplied by tax rate 25%. 25%. So I'm adding back the tax saving on interest, because what we need here is tax on PBIT, not the net tax. Done. Let me erase this. This is just an example. Okay. So now the NOPAT, net operating profit after tax, we have got this one. Double check whether we have taken everything. We have taken operating profit, depreciation we have adjusted, and then tax we have adjusted. Research and development expense added back. Oh, this tax must be subtracted. Tax is an expense. Subtract it. Yeah, now it looks good. So that's the net operating profit after tax. Similarly, adjusted capital employed at the beginning. Remember, all these adjustments are for previous years, nothing for current year on capital employed, because we are taking year beginning capital employed. Year beginning capital employed. Cool. So let me rewrite here. Net operating profit after tax is this, and then imputed interest is year beginning capital employed after adjustments multiplied by WACC. Oh, that's the other problem. WACC is not given. WACC is not given. Let's do the WACC. See, they have given cost of equity 12%, cost of debt before tax 3.8%, gearing is 45, debt over debt plus equity. That means debt to equity must be 45-55, correct? Then only you can say 45% is debt. So let me do the WACC calculation. Look at this. Cost of equity multiplied by proportion of equity, which is 55%, plus cost of debt, but mind you that is pre-tax, change it to post-tax, 1 minus tax, 1 minus tax post-tax, multiplied by proportion of debt 45%. That's weighted average cost of capital. So you have year beginning adjusted capital employed here multiplied by weighted average cost of capital. You get imputed interest. Better we'll put a minus sign because you're going to subtract it. There you go. And then your WACC, or the economic value added, is 1,320. That means, so this is already in millions. We are doing in dollar millions. So approximately $1.32 billion value creation the company has given to its investors. Right? Economic value given. Same way you calculate residual interest, which is based on accounting profit and accounting capital employed. This we have adjusted for the figures to reflect more economic concepts. So this NOPAT is more or less a reflection of cash flow made by the company, not exactly the cash flow. Once they asked in the exam, is this exactly same as cash flow? No, because it doesn't look at the working capital movements. It doesn't consider the investing cash flows, doesn't consider the financing cash flows. So it is not exactly the cash flow, but more or less it's close to the operating cash flow. Even operating cash flow, it doesn't consider the working capital movements. So it's like operating cash flow excluding the working capital movements. So it's an approximation rather than profit. NOPAT is an approximation of cash flow. And then capital employed also reflects more economic values of the assets rather than the book values of the assets. And you find economic value added, how much value has been added to the business. This is 2019 September December 8 p.m. exam question. If you understood, please subscribe to the channel. I'll be uploading more answers soon. Also, you can post if you have any doubts, any particular questions. I'll be trying to clear them through my YouTube channel. Also, please share it with people who might be interested. Thank you.